Paul Tudor Jones was on Squawk Box this morning, always worth a listen, and said even with a de-escalation of this trade war with China, it might not be enough. He said that even if tariffs go down to, let's just say, 50%, it's not good for the market. Listen, and we can react on the other side of that.
Even when he does that, you got those tariffs, the equivalent of a 2%. It'd be the largest. They're a tax. It's like the largest tax increase since the 60s. So you can kind of take 2 to 3% off growth. And then you got the Fed, who's, unless they got really dovish and really, really cut, you're probably going to new lows. And then when we're in new lows, the hard data will start to follow, and it'll probably create the Fed to move, create Trump to move, and then we'll get some kind of rally.
So, Bryn, what do I do with that? You can't dispute, really, what Paul Tudor Jones says. Tariffs are a tax paid by somebody and maybe multiple parties. That's not a political statement. It just is. You can, depending on what side of the political aisle you might be on, you can say, well, it's worth it because I believe in what the administration is trying to do in the big picture. But in the here and now, we're dealing with the situation of tariffs, which are, as he said, a tax, and it hurts growth. So what do I do?
I think you have to look at, first of all, Paul Tudor Jones, amazing investor. So I think when you get the opportunity, you have to put what he says as one of the scenarios, as one of the outcomes. And so, but I do think it's important because, Bessent, especially in Bessent We Trust, has been very clear about the importance of Main Street versus Wall Street. And those tariffs, Scott, are a direct tax on Main Street, not Wall Street. And so when you already have the lower 90% of the consumer spends over 30% of their income on goods, well, if all of a sudden when those tariffs become in the U.S., that is going to hit Main Street. And so that's where I think it was Bessent that said to Sarah Eisen yesterday, he's like, I have information that you don't have.
Yeah.
And so I think that
asymmetric information, right? Mm-hmm. Right? Which he should. And so, I hope he does.
Yeah. And so to that, in Bessent We Trust, I think that when you just play this out, this is not about tariffs. Okay, I have a chart that shows all of the tariffs we have with every country. Net tariffs in the U.S. are 2.5%. There's some low-hanging fruit like India, which is around 12%. China is a whole different thing. But if you go down the list, we basically have reciprocal tariffs already. This is about these non-tariff trade barriers, which I think are very complicated outside of India. And so I think that, Bessent saying I have asymmetric insights is asymmetric. I think Paul Tudor Jones has a scenario which you can't dismiss, but I do not think we even remotely are going to get there. I think the challenge is, from a market perspective, we're below the 200-day moving average. So for the viewers out there, that 57.50 is a ceiling, and you're going to need a catalyst. And I don't think that catalyst is going to be a Vietnam or a small country, Bangladesh trade agreement. You're going to need, to me, something meaningful to actually get the S&P to move up there. But also understand who's going to short this market. So for the CTAs and hedge funds, very, very dangerous scenario to try to short the market. And so I think the energy is actually to the upside, later on this year, because we all know one tweet and one big announcement, the energy is going to be to move higher. So I think in the meantime, we have a 2018 scenario where there's lots of volatility and range bound. But this is not a time to me to get negative and be a seller of stocks. It's like buy on the weakness. We will get through this. And I think that going into midterms next year, don't forget about that. Congress does want to get reelected, the Republican members. They're not going to let Trump have emergency authority and torpedo the economy for some Peter Navarro isolationist viewpoint that none of us in America have.
Yeah, you look at, the flows are pretty representative of Bryn's point of view. According to Bank of America, their client flows, institutional flows, shows buying across nearly every sector. Led by the obvious, maybe, tech, clients bought stocks in 10 of 11 sectors. They say the greatest breadth of sector buying in some 10 months, with only utilities seeing outflows. So where the market had taken a more defensive profile, maybe there's a little bit more optimism to what's gotten a little bit better. Sentiment's gotten better. And Utilities are seeing some outflows. Now you have rates moving back up, so maybe you wouldn't get as robust a buying in a bond proxy area like a utility, for example. But nonetheless, people are buying in and retail's hanging in. Those are two important aspects of this market.
Well, not only is retail hanging in, they're rushing in, right? $40 billion worth of purchases throughout the month of April. That's pretty much the momentum that pushed what we're talking about, the positive momentum since so-called Liberation Day. But I think it's important to focus on something you just pointed out, Scott, which is that utilities are the one sector that it seems like nobody wants to be buying right now, which is interesting for a market that is convinced that recession is right around the corner. Usually utilities are a thing you would be looking for, as folks are not going to be cutting their power and other things that fall into that category, even in the worst of times. But I'm wondering if what we're seeing is maybe a reshaping of what we consider to be defensive in moments of panic, where we saw initially Apple and Microsoft in the 2022 scenario where investors were piling in there sort of the safe haven trade. I'm wondering if we don't see that shaping up again, where the safe haven trade is hiding within tech. Maybe it's a Netflix, which is not directly tech, but it's pretty closely related. Maybe it's a Microsoft, something like that, where we look at those fortress balance sheets and say, even in the worst of times, I at least know that these companies won't stop investing in growth, they won't have mass layoffs, and they won't have the pullback in earnings growth that I expect across the board in other sectors.
I think those are all good points, Bryn, that Netflix to some degree has become a defensive play. And if anything, last week, we were reminded by the Megacaps of why all that money goes there in the first place. Why they have what some would suggest to be justifiable valuations that are higher than a lot of other stocks within the S&P 500. They showed you why.
Yep. This is why U.S. exceptionalism is alive and well. We have these companies that, for the most part, are capital-light companies, have tremendous amount of flexibility, operating margins. And so I think that you're going to continue to see, investors look at these companies, look at all of the earnings of these companies. I mean, Netflix aside, with the movie tariffs, overseas, that I think that's a headline for the day. But I think these companies are why America's exceptional. We have Silicon Valley, we have VC companies, we've got these mega cap companies that continue to innovate. And so, yeah, you can go to international and buy British Petroleum or Hershey's or one of the other names in the EFA, but ultimately, how much multiple expansion are you going to get from those? I think there's a cap. So I think that's where assets will continue to flow to these big names that have, by the way, low multiples. Jenny should like that with like a Meta or an NVIDIA, low multiples for growth or value investors.
Well, she perked up for a minute, at least at Meta, but then she just quickly
she faded on NVIDIA.
She quickly faded on everything else.